Hey guys, Tony Denaro here. Welcome back to the channel. In today's video, I'm going to be covering the basics for beginners about buying put options. If this is your very first video on options, you might want to go back and watch lesson 1, which covers some basic definitions, which I will assume that you already understand as I move through today's content. And without any further ado, let's get right into it. In today's video, I'm going to be covering with you what is a put option, how would you use it, and when would you want to use a put option? There are 4 basic option strategies for beginners, depending on whether your outlook is bullish or bearish, whether you think a stock is going to go up or go down. Those include buying a call, buying a put, selling a covered call, and selling cash secured puts. In today's video, we're going to be covering buying puts, a bearish strategy for beginners. By bearish, I mean that you have a feeling that a stock is about to go down and you'd like to figure out a way to make money on that. Buying a put option is a bearish strategy that gives you the right to sell 100 shares of stock at the strike price on or before the expiration date. Let's do a quick visual to give you an example of how it works, and then we'll get into more details. Pretend that this is January and we're looking at a stock that's trading somewhere over $120. Let's just say $125. And we think that by March, this stock is going to go down. In fact, go down well below $120. By buying the put option, we are setting ourselves up to make money anytime between January and the March expiration of the option if this stock does indeed go below $120. A common question I get is, what do I do after I bought the put option? How do I get rid of it? There are several possible outcomes once you buy an option. If you guessed wrong on the direction of the stock and it goes up instead of down, well, at the March expiration, your option is going to expire worthless, so your initial investment will have a value of 0 at the end of the expiration. The second possible outcome, and the one that is by far the most common for traders, is that you are going to sell that put option prior to its expiration date. Just a reminder, you can sell options at any point from when you buy them until the expiration date. You do not have to wait until the expiration. If we were successful in guessing the direction of the stock, we can sell that option to lock in profits, and if it is not going our way, we can sell the option to cut our losses. The third and final possible outcome is that you could actually exercise the option. I'm going to save the explanation for that for the end of this video if you stick around. In the case where a stock is expected to go down, there are 2 basic ways to trade it. You can either short the stock or you could buy a put option. Why would you want to buy a put option? Well, if you have a bearish sentiment, you expect that the stock is going to go down and you'd like to earn some income on that expected downward move, the put option could be for you. One big advantage for buying put options is that you have limited losses with options versus the other alternative of shorting the stock. Another common use of put options, if you own some stock, you might buy a put option as a hedge or insurance against any downside risk on your existing stock position. In other words, if you expect your stock to go down and you don't want to sell it, you can buy the put option, hold on to your stock, and actually earn some income from the put while your stock price is going down. We're just about ready to get into some specific examples, but before I do that, I just want to recap the advantages and disadvantages of buying a put option versus shorting a stock. Both moves that you could consider if you expect a stock price to go down. Both buying a put option and shorting a stock give you unlimited profitability up to the point where the stock reaches a value of $0. You're betting on the stock to go down, and you can make money all the way down to $0 on the price of the stock. One disadvantage of a put option is it has a limited time value. You have to pick an expiration date, and after that expiration date, your option will expire worthless if you have not done something with it. Shorting a stock, you can do that for an unlimited time. There's no limit on how long you can be short on a stock. The advantage of a put option is that you have limited loss. It costs you a little bit of money to buy the put option, but if you guessed wrong in the direction of the stock, that is the limit to the amount of money that you can lose. If you are shorting stock, on the other hand, and you guess the direction of the stock incorrectly and that stock goes up on you, you are facing unlimited potential losses as the stock price goes up. All right, let's move into the basics of choosing a put option. There's two things you're going to look at when you're choosing an option. The first is going to be the expiration date. That could be a day or a couple days from now. It could be months or even a year in the future. For this example, we're going to use an expiration date that is 30 days from now. And remember, once you buy your option, it can be sold at any time prior to the expiration date. The second item that you need to pick with your put option is the strike price. Let's take a look at a list of some strike prices for the stock Apple, and Apple is trading right now at about $175. The strike price is either going to be out of the money or in the money, and it is the opposite for put options than the way that it works for call options. So if the strike price is lower than the current price of the stock, in this case if it is lower than $175, then that strike price is considered out of the money. If the strike price is higher than the current price of the stock, it is considered in the money for a put option. The option premium, or the price of the option, will be listed in your brokerage app right next to the strike price. And you will notice that the options that are out of the money have a much lower premium than the options that are in the money. Now that we know the basics of picking an option include picking an expiration date and a strike price, let's talk about how we profit with put options. For this example, it is February and we're going to be using Apple, which has a current stock price of $175, and we think that the price of Apple is going to go down in the near future. I decide that I'm going to buy one put with a March 18th expiration and a strike price of $170. With this put, I will be able to earn a profit at any point between now and March 18th when Apple drops below $170. After looking up the March 18th expiration date and the $170 strike price, I find that the price of the option is going to cost me $515. After I purchase the option, time goes on, and here it is February 22nd, and Apple has hit a low of $165. I quickly check my brokerage app to see what the option is worth, and I can sell it today, February 22nd, for $773. After I subtract the cost of the option, $515, I'm left with a profit of $258, a gain of 50% in just 21 days. Remember that you can sell an option anytime between the day you purchase it and the expiration date, and in this case, since I'm able to get a profit of 50% in just a couple weeks, I'm going to go ahead and execute that trade today. As I wrap up this lesson, I want to talk with you real quick about how option prices or premiums are calculated, and I've got a new chart I'm going to show you at the end of this little lesson. An options price or premium consists of two components: the intrinsic value and the extrinsic value. The price of an option that is in the money is comprised of both intrinsic value and extrinsic value. If an option is out of the money, it will only have extrinsic value. Extrinsic value is made up of the time value, or the time left until the option expires, plus the implied volatility, or the IV. The IV is the likelihood of changes in the underlying stock's price. IV is very critical to understand, and we will do a video specifically on it. Today I'm going to focus on a very quick recap of the importance of understanding the time value in the price of an option. Time decay, also known as Theta, is a critical component of the value of an option, and it's something that you must understand. I did cover this in the lesson number 2 on call options, so we're going to do a very quick recap because the effect on put options is exactly the same. Once you buy an option, the value of that option decreases every day, every hour as time goes on. And more importantly, you need to understand that that time decay is exponential. The closer you get to the expiration date of your option, the harder that the time value, or theta, is working against you, the faster your option is decreasing in value. Because of this time delay, it is my general recommendation, when possible, when you can afford it, to buy options with at least 60 days until the expiration and then sell them early at the top of that curve before the time decay really kicks in. Going back to that example earlier, the put on Apple, I'm going to circle here in the chart where we sold at $165. You can find that 50% profit right there in the middle, lined up with February 22nd. The green zone is our profit area, and I want you to notice how quickly the profit potential declines as time goes on and we get closer to the expiration date of March 18th. In the interest of being thorough, I said I would come back and explain what happens if you want to exercise your put option. Most of you will never have to worry about this, but I'm going to put the information here so that it is here for you if you want to know how that works. Most people do not take this choice. They sell the option prior to expiration. Outcome number 2 in the list above. There are 2 potential scenarios in this exercising the option situation. One would be if you did not own the underlying stock. That's what we call a long put. Using our graph right here to the left, assume that at the March expiration, the stock that we're looking at is at $105 and our strike price was $120. We would buy 100 shares of the stock at $105, so $10,500. Exercise the put option, which gives us the right to sell 100 shares at $120 per share for a total of $12,000 from the sale, netting us a profit of $1,500. And to calculate our total profit, we would take this $1,500 and subtract from that the initial cost of the put that we bought. Again, this is not likely a scenario you will ever be in, but I have had people write me messages and say, hey, I forgot to sell my put and it just expired and it's in the money. What happens now? This is one potential scenario. If you don't have the money in your account to buy the 100 shares, the broker might just choose option number 2 and sell your put for you just prior to the market closing. But this is one possible scenario. Let's talk about number 2. In option number 2, you own the underlying stock and you bought a put as protection or insurance on that stock because you were worried about the price of the stock going down. This is also what we call a protective put or a married put. Now, you could have just decided to hold on to your stock and sell your put option and collect some money while the price of the stock was going down, but maybe you didn't want to hold on to the stock. Again, referring to our little chart here to the left, we bought the put with a strike price of $120 and the stock that we're holding is now declined in value to $105 per share. Let's go ahead and exercise that put option. When we bought the option, the stock was worth $120 a share or $12,000. Now here we are in March and the stock is only worth $105 per share or $10,500. By exercising our put, we now have the right to sell our stock for $120 a share. Even though it's worth only $10,500, we're going to sell it by exercising the put and collect $12,000. In this case, we end up with a net profit of $1,500 minus the initial cost of buying the put. All right, you made it to the end. I know that's a lot, and for many beginners, puts can be mind-boggling because you got to think completely opposite of how call options work. So when you're contemplating buying a put option, I want you to think about simple plays, maybe a stock that you think is going to go down or an index that you think is going to go down like the Dow or the S&P. Try and grab one with at least 60 days till expiration and sell it early so you're not hit with that Theta time decay. And if you don't have a lot of money or you don't want to risk a lot of money and you just want to buy one that expires in a couple days, go ahead and try that too. We learn by trying different things. In one of the very next videos in this training series, I'm going to be showing you live trades on both call and put options and show you exactly how they work in the broker app, so I hope to see you in that next video. I am Tony Denaro. I live stream every day during market hours. I hope to see you on one of the lives also where you can ask questions and just hang out with a great group of traders. Don't forget to buy and hold that subscribe button, and I will see you on the next video.
She thinks that I'm afraid that I don't break. I heard you question my